Hi everyone, hope you're all doing well. Today we're going to do a little bit of an update in the stock market, especially the small caps, mid caps, because they have absolutely tanked once again. New 52-week close as of yesterday on Friday of the close. And when these sort of things happen, especially the way that we are going down, it's not like little hits going down, it's quite sharp hits. Like when we do go down, it's like a good 5% hit. And there was a lot of stocks that did that on Friday. And when this happens, I think people want me to come out and just make a video saying, oh, this is my thoughts. Everything's going to be okay. This is all short-term activity, and remember to look into the long term. Now, I was going to do a video on Beyond Meat, but this is obviously taking the priority. I was going to make a video saying I'm really impressed with what Beyond Meat's doing at the moment, but we'll hold that one off for a later date. But yeah, getting onto the stock market, small caps, mid caps, growth stocks, absolutely slaughtered. A lot of it got pinpointed to JP Morgan. JP Morgan took a 6% dip on the share price. Their earnings were actually pretty impressive, but their outlook was a little bit mixed, and it just kind of put a lot of negative on the stock market. And this is what happens, just generally, it's people look for a reason why to blame why we're going down, but generally the reason why we're going down is just that everyone's kind of got that negativity going on, that bearish, that happens. That's the cycle of the stock market. All of a sudden, people are bullish, and valuations get pushed up to extreme valuations, and then next thing valuations are falling off a cliff, and they just go lower and lower and lower and go to crazy low valuations, and that's what happens in the stock market. It goes from one extreme to another extreme, and right now we are definitely at the extreme of that. We are very bearish towards growth stocks, small caps, mid caps. So yeah, that's generally what's going on. And you look at something like a DraftKings, for example. DraftKings put a new 52-week close today, $22.48. It did lift up a little bit slightly towards the end. I don't know why it keeps putting me on the London listing. I don't know why this is, but yeah, this one. It took a big beating today. I mean, look at that. I mean, that's no small move, really. To 8% is a fair amount of drop. And once again, we're hitting new 52-week close, and this comes after a week of really positive news for DraftKings. The New York State launch going, and everything like that. And what happens? We go to new 52-week close, and you can. This one's a little bit more up for debate, whether or not you think it's a good company, if you think it's cheap valuations. I mean, right now, obviously, as you guys know, I'm very bullish on this space in the next few years. And when I look at DraftKings in the next few years, I think it's going to be a great company. And I think that when you look at the growth in it is great. You got like a stock like this falling at 52-week close. Teladoc, once again, pretty much nearly hitting 52-week close on this one. And it's also creeping into like other growth stocks, like Boohoo, for example. Boohoo, I don't generally know what happened with Boohoo, but yeah, 10% down in one day. It just slowly kept, falling off a cliff. And, something like a DraftKings and Teladoc, they're always going to be up for debate. And it's always going to be up for debate what you think. The thing with like a Teladoc and DraftKings, for example, is like, is very hard to argue. Or like concrete, the stock market is a game of opinions. Everyone's. When some people are buying stocks, people are selling stocks. When people are selling stocks, people are buying stocks. DraftKings is up for debate whether or not you think it's a good valuation, if it's going to be a successful company, because it's quite early on. It's got a lot of growth, and you're basically paying up for the growth, and then what you think it will become in a few years. That's generally what growth stocks are. Same for Teladoc. You're really paying up for what you think Teladoc will be. It's at an earlier stage of its life of its company. So that's always up for debate whether you think it's cheap or it's still overvalued. I mean, obviously for me, I think they're both extremely cheap right now. But when you start looking at other stocks as well, you're looking at stocks like Boohoo, and you look at a stock like Boohoo that's been caught up in this whole growth sell-off, for example. And once again, you're looking at a stock like Boohoo at £1, and the thing is with Boohoo, you can't really argue that it's not cheap. You can look at it and maybe you can question potentially what it has. Maybe it might hit some hard things, competition going forward in the next kind of few years. But you look at Boohoo at the moment and you would look at it and go, okay, it's 23p ratio, even with logistic problems going on, 52-week close. It's still a company that's growing at 30+%, amazing balance sheet. You look at this one and you think, if this is why it's really important to look at companies where they're going to be in the longer term. Like if you look at Boohoo and you think, where's Boohoo going to be in the next 2, 3, 4, 5 years? and you start running, okay, just put an average rate of it grows at 20% every year, 25% every year. Start working that out year by year. And you start working out, okay, so from that, what's the profit going to be? Okay, you start working out the profit. What could the potential profit margins be? You start working that out. And then when you start running like the numbers on Boohoo and you start going further and further and further down the line, 2, 3, 4, 5 years down the line, then you start looking at that and you start looking at something like a Boohoo and you go, that's cheap. That's what's the big thing is you need to start looking at what these companies are going to do further down the line. Like I said, the growth stocks are a little bit up for debate, but there's even companies like this that are up now, and you're looking at these and you're thinking, wow, pretty good valuations, isn't it? And it's something like an Inmode as well. Inmode is a company I love. It was my biggest position at one point. It's not anymore. I'd love it to be probably. I won't mind it to be my biggest position again, especially when you're giving me a dip that it's on. But like an Inmode, for example, you've got a company like Inmode that's just lost 50% of its value within 3 months. Sure, it's been on a pretty decent run, but to lose 50% of your value in 3 months is a lot, and you look at this here, and it's at a P ratio of 28. Let's just look at Inmode. So Inmode actually just reported preliminary Q4 earnings this week. Their Q4 preliminary earnings were fantastic. So they came out. So normally when you bring preliminary earnings out, it's either to go, this is going to be really bad, just to let you know it's going to be bad, or it's either our results are going to be really good, just to let you know this is how good they are. That's normally why preliminary earnings come out, and for Inmode's case, it was they're going to be fantastic. So once again, they came out, reported preliminary earnings. They were in the range of 109 million to 110 million, compared to the consensus of 99 million. So yeah, that's an absolute 10+% beat on there, 46% year-over-year growth. If you look at the EPS here, they are going to report as 0.61 to 0.62, and the consensus was 0.53. So once again, that's a massive hike on the consensus of the EPS. So you've got a revenue beat, you've got an EPS beat, and they also came out and guided. I thought the guidance was a little bit light, but it was in the expected consensus range. Inmode are good at that. They're good at sandbagging and then over-delivering. They've done it. They do it all the time. And once again, when they brought this news out, the stock went up, but because we're just in such a negative and bear market, what happened? What has happened this week? Well, we had a jump, and then what has happened since then? The stock sold off 15%. Originally investors went, oh, that is absolute. Wall Street went, oh, that's absolutely fantastic. They're great numbers. Then, oh, hold on, guys, we're in a bear market. Oh, it's all so bad, isn't it? We all need to sell our stocks. It's not great, and people sold it. People sold it. That jump happened, and then people decided, oh, you know what, I'm going to sell it, and it 17% drop, and that's how much negativity and how much fear there is out there right now. This is what we're in, guys. We are at a very bear market cycle right now for a lot of growth stocks. This is it. This is a stock that is trading at 28 times earnings. On a forward basis, I think it's like 18 times earnings. It's a company that just grew 40% revenue growth, massive profit growth as well. It's at 28 times earnings. Only if you go 12 months ahead, it's going to be trading at 18 times earnings. Fantastic company, great valuation. And once again, you can debate a couple of growth stocks for sure, but when you look at stocks like this, then you start to realise how negative we are in the stock market and how much things are just getting beaten down right now. Now, a few days ago, I actually shared this graph with you, and I said, where do you guys think we are on here? We generally don't know. We won't know where the stock market wants to take us. The next few days, you might see the stock market put a bounce in. This might be it. This might be the bottom. We might consolidate. We might go up. Generally, though, we don't know. We could be at the denial stage. We could still have a lot more to go yet. We might have a lot of flat line to go yet before we see the bottom. We generally don't know. That's the thing about being an investor, is not trying to time where exactly we are, but looking at, okay, I like that company. That company's lost a lot of value. Maybe I buy that. And in particular, when this dip does go on for a longer period of time, it's actually a little bit better because, like, for me personally, I've burnt through a lot of cash buying the dip at the moment, and because things keep going lower and lower, I'm looking at these dips now and I'm thinking, I actually won't mind for this dip to carry on for a few months. Because if it carries on for a few months, then what happens is that I can keep regenerating a bit of cash, keep buying the dips, and I keep getting these amazing companies at crazy cheap prices. And if I get my averages lower or buy more of them cheaper companies, when the market cycle does change, then I will have some amazing companies at cheap prices. And that's all you can do. You can't really time it. You don't know when it's going to go up. You don't know when it's going to go down. But sometimes it just changes. When we were having this run up here, probably from the CV dip to February 2021, when we were having a bull market cycle and it just kept going up and up and up like this, you look at some days, you're thinking, is the stock market ever going to dip again? It just keeps going up and up. And now the total opposite has happened. We're at the point where the stock market is doing this, it goes down, down, down. And you've got to the point where you're like, is the stock market ever going to go up? Are we actually ever going to go in the right direction? Are things ever going to work out for us again? And that's the thing. The cycles happen so quickly, and when them cycles happen, the mentality switches so quickly. And one day, we will go back on this cycle here, and believe it or not, one day we'll have a stock market that will go up and up and up. And you'll probably look at it and go, oh, I don't think it'll ever go down again, and that will happen. It will rotate to that. And only a few months ago, I saw a lot of people saying, when we get to January, it'll be all right. We'll have, this is tax loss harvesting. We'll be okay when we get to January. That will be when the stock market rebounds. But as you can see, guys, you can't time the market. People will tell you, oh, I think I've got it. I think I know how to do it. I know how to time the market now. This is it. You can't. Honestly, you cannot time when this change will happen. You can't time when it goes down. You can't time when it goes up. All you can do is manage risk to reward. That's all you can do as a stock market investor, and buy great companies that will do well. I want to finish off with this stock as just a bit of a point of view. It came up on we did a bit of a Patreon video on Tuesday, and this stock came up, and it got me thinking about a few things. And I mentioned something very similar about that. If you watched the Hollywood Ball video yesterday, then that was a bit similar. Lam Research is a really good example of what you need to be prepared of in the stock market. Like, there's periods of time where, Lam Research, had nearly 2 years where it did nothing. For 2 years, you could have looked an idiot holding this stock. 2 years, you would have gone, all these stocks have gone up so much, and I've held this stock and it's done nothing for 2 years. I look an absolute idiot. And this is the big thing with investing. There's periods of time where you can look idiots, you look an idiot, and there's points where you would have been down 34% on this stock. A year's time, 30-40% down on the stock. You look an absolute idiot holding this stock. But if you've got belief, if you average down on the company, then let's just say you get your average at $172. What happens? Next 4 years or next 3.5 years, the stock goes up 322%. Now, after that stock going up 322% in 3 years, 4 years, what happens now? Do you still look an idiot? No, you don't look an idiot. You look amazing. You look like a really good investor. You look a really good investor because what you have is, oh, I wish I could do that. The conviction, the patience, the buy the dip mentality of a great company. And this is what happened. I was very close to buying this company a few years back. I never bought it in the end, but obviously maybe I should have done. But this is a prime example of a stock that just did nothing, went down for a good period of time, and you look an idiot for a long period of time. But boom, within a couple, you could not time it. That potentially when we got to the 24th of May 2019, everyone went, oh, that Lam Research is a company, we're going to go buy it. There's no way you knew that, but it happened. And all you can do is look for good companies and buy good companies. And as long as you have companies that increase their revenue, as long as you have companies that increase their profit, you also have to have a little bit of metric expansion. So obviously with something like Lam Research, what would have happened is obviously metrics get a little bit higher, which we had in February 2021. Obviously companies that are doing very well, and them stocks will go on a good share price run. Obviously what we have at the moment is still companies that are doing very good, but you've had a lot of metrics that have started compressing. And what will happen is longer term, 2 to 5 years, as long as you're buying companies that are growing revenue and have a vision of going to profit or growing profit, and then you have that metric expansion once again, we will start moving in the right direction. And that's what I wanted to finish on anyway, guys. So I hope you enjoyed it. Have a good weekend. If you could hit the like button, that'd be absolutely amazing. And I'll see you next video.